So I want to highlight also what Jamie Dimon said in the press release as well. Here's the key for me. We have always invested, even in difficult times, in our employees, customers, and communities. And as a result of the tax plan, we will be increasing and accelerating some of those investments. Megan, is that already priced into your outlook, that those kind of statements on earnings calls?
Yeah, it is. That we'll have some increase in investments. And I think this is one of the most interesting pieces of these is the loan growth. And I do think there's a lot of optimism about a huge, surge of loan growth off the back of this tax bill. We're not going to get a surge. We'll get some as companies are waiting for the tax bill to go ahead and invest. We'll get some pulled from future years as well. So we're not creating new investment or new loan growth. We're just borrowing it from the future. So I think for 2018, it will look better. It's just a few years down the line, that will peter out.
But that's a key point, because if you take a look at the numbers, there's a distinction between all the equity trading, the FIC, investment banking, and then what they're saying about their credit card business and their loan business, which the numbers appear to be pretty solid. Core loans were up by about 6%. Provisions for credit losses fell sequentially. You also wound up having, so with those ideas, it feels like we're in a better place. Overall provisions were also lower. Can you help me make the distinction, Alison, between the two?
Well, I think, provisions, lower loan growth is going to translate into lower provisions. So that's one thing to keep in mind. And 6% is healthy, but that was a target that was sort of lowered throughout the year. I think in terms
so you
of
don't like the 6%?
Looking to the future, well, I think it's good given the environment. So,
okay.
Maybe not good if we were here a year ago. And looking out. But the other thing to keep in mind is that there is an offset to this lower loan growth, and that is debt capital markets fees. So to the point that we will get some acceleration in loan growth, keep in mind they've been making money still from companies borrowing, but it's just on the debt capital market side. Very strong underwriting there this quarter. Equity underwriting also very strong, and JPMorgan bullish on the outlook. I guess the other thing to highlight in terms of provision and loan growth, the key is really, again, what is the outlook? And I think we'll probably get more detail around that at their investor day in late February. They're probably going to be a little bit hesitant to set all of their targets today and want to, save some for then.